Hello investors. Today we are going to talk about the Happy Forgings IPO. They're into forging and manufacturing of machine components, primarily into four segments of commercial vehicles, farm equipment, industrials and off-highway vehicles. They have three manufacturing plants spread across 74 acres in Ludhiana. Until date, they have spent around 1200 crores in capex, out of which 500 crores has come in the last 4 years. The funds from this IPO will be used for expansion purpose and debt reduction. Happy Forgings has a total of 66 clients, out of which they have added 36 clients in the last 6 years itself. Some of the key names are Tata Motors, Mahindra, JCB, SML Isuzu and Liebherr. Now the IPO details. The face value is at ₹2 per share. The price band is ₹808 to 850. The lot size is 17 shares, which means per lot it's 14,450 rupees. The total issue size is 1008 crores, out of which the fresh issue is 400 crores and the OFS is 608 crore. The IPO opens today and closes on December 21st, the allotment by December 22nd, and the listing date is December 27th. Let's have a look at the financials. The revenue and profit after tax both have grown in the last 2 years. The revenue has grown by 38.81% and the PAT has grown by 46.67%. Over the last 10 years, the revenue has grown by 18% and the EBITDA has grown by around 24%. The reserves and surplus has also increased over the last 2 years and the borrowings have remained stable. Let's look at the key ratios now. The PE is at 36.45, which makes this IPO a fairly priced one. The ROE, ROCE are both above 20, which is a healthy number. The EPS is at 23.32 and the GMP right now is at 460 rupees, which means you can expect a listing gains of 60% if you're lucky to get this IPO. The competitors in India have actually done really well. The likes of RK Forging, AIA Engineering, CIE India and Bharat Forge have done exceedingly well this year. Now the risks and strengths. One of the key risks is the limited suppliers and non-definitive supply agreements from steel suppliers, because the moment the price per kg of steel increases, the EBITDA margins get heavily impacted. Also, the heavy dependency on the top 10 clients, from where right now the revenue is around 67%. The company, however, has mentioned that they plan to reduce this to 50% by FY25. They also have a huge dependency on the sale of one of their SKUs, which is the crankshaft, and the growth in revenue is lower than peers in 2023. One of their key strengths remains that they are one of the largest engineering-led manufacturers and they actually have renowned OEM clients globally and in India. We did discuss about the top 10 clients contributing around 67% of revenue, but the good thing is that they have an old business relationship extending from 11 to 22 years. Their EBITDA margins are one of the highest among peers in the last 2 fiscal years, and also they have a steady growth in their top and bottom lines. In the last 6 years, they've added 36 clients, all in the industrial segments of wind turbine and industrial engines, which is pretty good. Now the verdict. Considering all the positives, the green flags, and the way the company is growing, I believe this is a fairly priced IPO and I will go ahead and apply for this one, and also keep a tab on the growth for the next 2 to 3 years in order to see if it fits my long-term portfolio. If you like this video, please do subscribe to my channel, share it with your friends, and hit the like button.